Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Helen Chen, Lead Manager of the FSSA Greater China Growth Fund, which features on our wealth shortlist of funds selected for their performance potential. So Helen, the FSSA Greater China Growth Fund can invest across China, Hong Kong and Taiwan. So what sort of characteristics do you look for in companies?
For our team, we generally look for quality companies, which means that it is run by capable and credible people, have a strong franchise and sound financials. In Greater China space, I particularly look for companies that with a visionary management who has a vision to grow the company to the next stage and to reinvent the companies amid the challenges. And I also look for the companies with a solid competitive landscape, because in Greater China space, the competition can be really fierce.
And how are you investing in the portfolio at the moment, and kind of what excites you about the companies you own?
So the fund has around 70% exposure to China and around low 20s percentage to Taiwan, and the rest to the Hong Kong companies. What excites me is that after the correction in China in the last couple of years, the Chinese companies are trading at very attractive multiples, and which means that they can generate the good reward for the shareholders. In the last couple of years, the Chinese companies have been rewarding the shareholders increasingly with the dividends and share buyback. So in the China universe, the total shareholder return is now more than 3% versus a long-term treasury yield of lower than 2%, which gives us a good opportunity to invest in the China equities.
And 2024 was a good year for China, but it was a tough year for active managers investing there. What do you put that down to?
Yes, indeed, it was a challenging time for the active managers in China and Greater China space. There are a couple of reasons. First of all, there are certain companies that we do not invest in or do not have enough exposure to actually did pretty well in the Greater China space. This will include some of the SOE companies in China, such as the oil companies, the coal companies, the large SOE banks, which we do not typically invest. People got excited about them because the dividend yield was very attractive, whereas the growth in China actually disappointed. And there are certain technology companies in China, such as the Xiaomi and the EV companies, which has also done well. In Taiwan space, TSMC actually went up by more than 70%, and it was 20% of the index, which dragged the relative performance of the Greater China strategy. On the other hand, some of the holdings that we own actually did not do well in the inflationary environment. A typical segment is a consumer segment in China. So this dragged the relative performance of the fund.
And on geopolitics, there's a lot of noise at the moment about the relationship between the US and China and what might that look like in the future. What's your view on that at the moment?
Well, we don't have a crystal ball to predict how the policy will go. The situation is a little bit complex, and it actually started not from this year, but from 2018. As China becomes the second largest economy globally, the confrontation with the US will last for long. But our view is that for China, it's actually relatively well positioned as of today versus a couple of years ago due to a few reasons. First of all, China has a large population of 1.4 billion. So the domestic consumption can support the local economy to hold still in this uncertain global environment. And secondly, because China has already suffered from slower growth due to the property crisis and the government's policies in the last couple of years, so that the Chinese companies have already adapted themselves to this slower growth environments. And they've cut down those loss-making departments, cut down the redundancies, focus more on the ROI. So we feel that they are more prepared for the challenging environment. And lastly, the Chinese equities actually trade at very attractive valuation. So we feel that they can reward the shareholders with solid earnings and the downside support in the future.
And reflecting on your career so far, what top investment tip have you picked up along the way that might have been useful to know back when you started out?
Mean reversion. So when I started, I was I grew up to be a growth quality investor, but there was a time that when all the market were pursuing this quality growth, it became very expensively valued. So there was a mean reversion towards those cheaper valued, unnoticed companies in the universe. I think it's all about balance, and so mean reversion is a tip that I get.
And who would you say has had the biggest influence on you as an investor?
I would say Angus Tallock, our team's founder. Although I worked with him not for a very long time, but then he did give me a lot of strong impression. When I worked with him in 2012 or 2013, I was looking at a PC company in Greater China. And then he said to me something like, I already started using iPad, so why is a PC having a future? And this actually marked almost the peak of the PC market. I felt that a lot of the things for investment are actually quite simple. And so he did give me a lot of influence on that.
And outside of work, how do you switch off?
I started playing the piano since COVID. I learned it as a kid, but then I didn't play it for almost like 15 years before the COVID. And I felt like I get relaxed and also have something to let out when I played it.
Great, Helen, thank you very much for joining us.
Thank you, Joe.